We often hear about consolidating our debts. What does that actually mean? Well, as the term consolidation suggests, what we're doing is we're bringing together all our different debts into sort of one or two larger pools that we can more easily manage and ideally get the interest rates down on. How do we get interest rates down? Well, when we think about how money is lent, the more risk there is for the lender, and the more money he wants to make, the higher the interest rates that we pay. So in a situation where we're borrowing on credit cards, where the risk is very high because the likelihood of not being repaid is quite high, interest rates are also very high, and obviously credit card companies also want to make money. But the reality is the risk is also quite much higher for the lender. When is the risk not high? Well, the risk for a lender to lend money is not high when they're lending money in a situation where they're more likely to get their money back. And they're more likely to get their money back when they're lending to somebody that's buying an asset that can be sold in order to repay the debt. So for example, when someone lends money, when a bank lends money for someone to buy a house, in a worst case scenario, if they can no longer afford their interest rate payments, the house is sold, the debt is repaid. So the likelihood of there being a real loss is actually quite limited from the lender's perspective, and therefore the interest rates that the lender demands tend to be lower. That also, of course, means that we as borrowers, if we have to borrow money, and we want to borrow money, pay lower interest rates when we borrow against assets. So when, for example, we borrow against our house, our interest rates tend to be much lower than if we borrow typically in almost any other way. Plus, in the United States, interest payments on our mortgage are tax deductible, which means we don't have to pay tax on the money that's used to repay that debt, which also makes it more attractive. But most importantly, when we borrow against things that can be sold, for example a house or even arguably a car, although interest rates are higher, then we can save our interest rate payments and get our interest rate payments down quite a bit versus borrowing against things that decline rapidly in value or where the risk for the lender is very high, and for example, as it is, for example, in the case of a credit card debt. So consolidating debt typically means bringing our debts into larger pools and ideally getting the interest rate down by borrowing against assets or by borrowing against things that have value, and then decreasing the risk from the lender's perspective and thereby decreasing the interest rates that we have to pay as a borrower. Now, when we borrow against assets, clearly we get our interest rates down. That doesn't mean, however, that we can do it, just as much as we think we might want to, and just go crazy and borrow as much as we want. When we default, let's say we buy a house and we take on a mortgage and we default on those payments, very often we lose our house, and that's a real problem. But nonetheless, in order to get interest rate payments down, this is typically not a bad idea, and we can get our interest rates down in that manner, and borrowing against assets tends to get the interest rates down the most and can be tax efficient because the interest rate payments are tax deductible.